I don't think the market's going very far. It's my personal view. So, Navneet, what is the bull case scenario and the bear case scenario for FY16?
I completely agree with him that the re-rating is behind us. I mean, that was driven by the bottoming out of macro, the political mandate, the global improvement. All other markets have done well. And going forward, the markets would track the corporate earnings. So we have to see the earnings. I was surprised by the survey where more than 50% people said that it would be more driven. Either the largest factor is going to be government action, the reforms. But I think it is mostly the corporate earnings. And I think if we see the 18-20% that Akash talked about, maybe we can see a 20. Of course, markets don't give returns in a linear fashion and exactly in line with the corporate earnings. And also at the end of the year, what's your projection for the next 2 years? That would determine. But I would guess maybe a 15-17% would be a good bull case scenario for the next 1 year.
Prabhat, ultimately it's all about evidence. As of now, it's hope and global liquidity which has taken markets to a new high. Do you think now the script of market movement will be a function of earnings and evidence?
So I think, first of all, I think there have been positives, and it is nothing to do with only the earnings. There has been a massive, improvement in India's macro situation. So there was a time when your current account was growing up, currency was very volatile. We were, one of the fragile 5 economies in Asia, and I think from there we have turned complete 180 degrees. So part of the market re-rating happened on back of that, and the next part obviously was because of the government change and what you call hope factor. So obviously long term, the multiples are a function of both the cost of capital and the growth that you are exhibiting. I think that a large part of cost of capital change that had to happen has essentially been already baked into the market, because you have seen the for example, last surprise cut market didn't react. So market is pretty much baked in low inflation and better current account, etc. So it has to be growth from here on. But if the growth really picks up, then I won't discount some multiple expansion even from here, because if you look at the overall market makeup, there is a very expensive market still out there, and there is still compared to history cheaper market out there. So if you start looking at disaggregate the market between the two extremes, the defenses are 15% more expensive than the history, while the non-defensives are 10% cheaper. So it's a market which is actually not really baking that much growth in. It sort of got disappointed and banks have pulled back. So the differences actually widened in the last 3 months or so. So I think if growth comes, you actually could see, I think, more than 20% return. And I so completely agree with Akash what he said in terms of growth acceleration. It will be lagged, and the evidence. But I think evidence, once it starts, the belief in the evidence and durability of that evidence probably will be much higher.
Nilesh, the core thesis for FY15 has been a stable political mandate, Indian macros are in place, and demise of oil. But if I look at the market behavior, the leadership still rests with pharmaceuticals, with private banks, and to a large extent IT. If the core belief is that economy will make a comeback, then why global dominated sectors are doing well?
So it's not entirely true that all the global dominated sectors have done well.
Barring private banks.
I mean, techs have underperformed compared to say banks. Banks are up 80-90%, techs are up 20-30%. Pharma is up purely as a better defensive to technology and FMCG. If you see some of the construction companies, they have multiplied 2, 3, 4, 5, 6 times. So clearly there are certain parts of economy which have done well. There are certain parts of stock market which have become expensive. I mean, it's very difficult to justify one large auto component company's valuation when for last 4 years their profits have grown by 10% and stock is up 400%. So there are various things which have worked. I mean, clearly people have invested in their comfort zone. So you had holdings in some of the sectors which you talked about. You kept on receiving flows. You kept on buying the same stock irrespective of where the valuation is, and probably that has resulted into some of the things which you talked about. I just want to bring one more point into this discussion. Let's look at what is happening in the unlisted market of India. We have seen some of the technology companies, e-commerce companies, some of the ventures which are all getting money at valuation which is reasonably high. It's getting
reasonably high, you mean charitable?
I'm on a live show, that's why I'm saying that. But quote unquote reasonably high. The quantum of money which is coming in is also reasonably high, quote unquote. So what's happening in unlisted market, can that happen in listed market? My guess is that probably in one part of listed market, we have already seen that happening. Some of the FMCG companies, some of the autocom companies, some of the even construction companies are trading at very, very high valuations. And probably rest of the market can actually catch up with what's happening in unlisted market based on the flows, both from the domestic investor as well as global investors, based on lack of supply, which didn't come out in FY15 as much as one would have liked to see at this level of valuation. So lack of supply and more demand can create in our listed market what actually happened in FY 2015 in unlisted market.
You know, but ultimately it's all about growth, Siddhartha, isn't it? So as an economist, what I want to understand from you is that when will general growth come back? If I look at the basic numbers, the IAIP data, or for that matter, the credit off break, it appears that growth is still very, very anemic. The feel-good factor has changed, but the on-ground economic evidence is very, very different.
Yeah, very true. There are two ways of looking at it. In our initial year in the management school, we used to be taught about that two-factor model, right? Hygiene factors and motivator factors. Now, if you see now using that particular model, you would see all the hygiene factors are very well ticked now. The current account looks very well under control, inflation well under control, fiscal deficit looks good, interest rates can go down further. So it's all, these were all some kind of headwinds sometime in 2013 or till early 2014. They are either neutral or coming back as some kind of a tailwind. What is still bothering us is possibly while we still say that there's a surge in confidence at the moment, possibly that's still true in terms of a bit of consumption sectors where the results can be seen relatively quickly. But when you are talking about the long gestation investment projects, the general stance is, I'll rather join the party 6 months rather too late rather than joining it six weeks rather too early. So people will remain cautious. I think we have to see some kind of slow cyclical upturn for the next few quarters before we really see the investment cycle turning around. Just to sum up in terms of our numbers, we are expecting a growth number of around 7.5%, 7.4, 7.5% in the financial year just concluded. Next year, where can we be? We are going with a number of slightly higher, just about 7.8%, not a lot higher, somewhat more conservative than the government's estimate of 8 to 8.5%, solely because of the fact that the big uptick in investment, which really propels India's growth, will possibly would have to wait still a few more quarters.
So Prabhat, what happens in the interim? Everyone is waiting for growth. The evidence is indicating that slowdown or perhaps the real pickup is not here. Flows are strong and too much money is chasing too good, few stocks.
So I think that the growth is not here is, well, I personally believe that you'll start seeing signs of growth pick up in about 6 to 8 months time. So let's not sort of say that growth is not going to be there forever. And the markets will probably be a bit forward looking as far as growth is concerned. The important thing is that what is the durability of the growth profile. Now essentially what we have seen, Nikunj, is that we've seen a complete decimation of investment cycles. Looking at some data, and the banks sanctioned about 1,35,000 crores of project in FY14. This number in fiscal 5 was 95,000 crores. So you have essentially, if you adjust for nominal sort of inflation, then our investment cycle is back to where it started from in 2005. So we have seen a complete destruction, and which is why our economy has been so painful in the sense that you've seen zero IP growth for 3 years roughly, which has never happened in the last 20 years, because we had a rapidly sort of declining cycle in many areas of the economy. So I think from that base, getting a bit of growth is not that difficult. And the second thing I think is that government finances have been very weak. They will improve next year. There will be some spending which will be extra, and some benefits from consumer in terms of oil prices, some sentiment improvement. So I am not that bearish on growth being forever elusive. I think we're probably closer to it. So I was more bearish last year on growth, then I should be this here. So evidence, obviously what evidence points to, market tends to do that. That's why market has beaten down banks and et cetera, compared to FMCG. But I think to commit here that the growth will not pick up is probably sort of looking at the rear view mirror and saying, oh, things will still remain bad for a long time. So I think probably it's time to start looking at spaces which have underperformed and start buying those.
So Akash, assuming that growth will pick up, it's a cycle and ultimately that cycle will pay out. How should one position themselves going forward?
Well, I mean, we have a slightly different approach where we are very stock specific. We don't really play sectors. So, I think what we're trying to do is look at normalized earnings for companies. So if you assume, that everyone says that, the last 3 years India has grown at, forget the new numbers, but let's say somewhere around 5% GDP. And obviously in many sectors, therefore you have, and obviously it's well documented that corporate profit margins are way below trend, right? I mean, I think profit GDP is 4%, the long-term trend is somewhere 6, and the peak is 7 something, right? So I think what we're trying to do is look, if you look at companies, you see that if you assume in the next 12, 18 months, you'll get back to, again, under the old series, because I'm still not comfortable with the new series of back to 7% type of economic growth at least. And then you assume that, companies get back to, a normal margin structure. Right? So like, for example, if you look at auto, right? I mean, you look at whatever company you look at, you had 20 years of 15% growth, last 3 years is 0. You'll probably get back to 15% trend lines. You'll have 1 or 2 strong years, but if you're discounted, assume you get back to 15% growth, assume discounts normalize, look at operating leverage. So you look at what companies are trading at on normalized earnings. I think that's how we're looking at it. We're not really saying that you should be playing defensive or you should be playing, offensive. I mean, I think that's a very, nothing wrong with that. It's more a sector rotation type of model, which we don't typically do. So our sense is that good quality companies will come back to strong growth. The problem in the market, unfortunately, is that this, and this is true globally, is that quality has gone to a very high valuation. So the problem is that, it hurts our style because we tend to try to buy quality at a reasonable price. So the game has changed now to finding companies which either the market doesn't understand that they're decent quality, or there is some question mark around that, and you're making a judgment saying that it's actually a decent company, the market doesn't think so, because buying the obvious quality companies are just very expensive. I mean, it's just very difficult to, there is no margin of error. If you're buying just as an example, HDFC Bank, an outstanding bank, but it's priced for everything. I mean, even if they grow at 25% compounded, multiple holds, it'll be fine, but you're making a real bet that, and I'm just using HDFC as an example, that you have to be 100% sure that they will deliver what they're saying, because there's no margin of error. So the problem we are facing, and I think everyone has to face, is we are not comfortable as an investment style going down the quality curve. It's a perfectly legitimate way to invest. Buying some beaten up infrastructure company, or that's fine. It's not, we're not comfortable with that because we don't have conviction, and we tend to make stupid mistakes. And then one bad piece of news comes, we'll make a dumb decision and sell, and we don't have conviction. So if you're trying to focus on quality, it's a very difficult market because it's not cheap and everything is priced. So I think you've got to look at pockets or companies where the market is not valuing them as quality, but they really are a much better business than the market thinks they are. So they're few and far between, but our model doesn't require us to make more than 5, 6 investments a year. So for us, it's okay. If you're running a very large portfolio and you need to make a lot of investments, then I guess you'll have to look at sector rotation, or you'll have to look at going further down the quality curve and stuff like that. But our working assumption is that growth will come back. I mean, frankly, you should not be invested in the market today if you don't believe growth is coming back. That's an implicit assumption. I think you'll get the next 6 months, probably the market will have an air pocket, because there is some doubt developing among some investors that will growth come, because the earnings have frankly been worse than anyone would have predicted. And March will be really bad. I mean, that's I think quite clear for many companies we talked to, that Jan was worse than December, Feb is worse than Jan, March is worse than Feb. And it's just going down. So I think this will test conviction now, because the March number will be horrendous. Then because of the the unfortunate rains, I think even June will be bad. The quarter is quite mediocre. So it will test conviction. And if you don't believe growth is coming back, then you're going to make mistakes. So I think the working assumption is growth will come back. Second half of this year, acceleration will be clear. And within that construct, I think you're going to find those companies where are not valued for high quality, but actually are much better businesses than you think.
Navneet, I'll take a leap from Akash's answer, which is that in the short term, nothing will improve. That's the period of air turbulence. So how are you laying your bets so that your portfolios don't suffer in this period of mid-air turbulence? And B, where is your stand on quality versus price?
We are also a quality focused house. I would disagree with that. Nothing is going to improve in the short run. There's a bit of disconnect between the macro and the micro. I mean, by micro, I mean the corporate profitability. The reasons which are responsible for improvement in the macro that Sanjeev or the other people talked about in terms of we've got control on the current account, inflation is under control, the fiscal deficit has come down. The same reasons are responsible for the impact, the negative impact that we have seen at the micro level. So government has cut down on expenditure big time in last 1.5 years, particularly the wasteful expenditure, which was boosting consumption. Obviously, it's going to get reflected. If we were running a negative real interest rate, of course, it was impacting current account, it was impacting savings. Now that we have got a positive real rates, we ran a tight monetary policy. We'll see the positive effect later. I think that government is going to spend good amount of money in next couple of months. I'm not talking like couple of quarters or years, but I think immediately. So they have built a good cash surplus because they had to ensure a 4.1% fiscal deficit. Similarly, the state governments have been allocated a lot more money, and now I think they have a helping hand from the center. Also that I think this whole might sound like a cliche now, cooperative federalism, where states are competing against each other. I think a combination of government, the central government and the state government spending in next couple of months will start showing result on the ground. And I think we'll see that in next couple of months when the money really hits the ground. At least in some of the sectors, railways, roads, mining activity would start after the new allocations. So we'll see some activity in the defense related orders that have been given. So at least the industrial space, I think a little bit of discretionary space will start seeing better days ahead. So I'm in the camp where, of course, the results in March are going to be really terrible. Completely agree with Akash. May not be in June, but I think beyond that, I think people will get a little surprised.
Coming on this quality argument, what is growing is expensive and what is not growing is cheap. You're a quality fund house, so how are you differentiating men from the boys?
No, of course, I think so. There are various definitions of quality. What we have done, so when we had a big macro challenges, of course, you try to be as defensive as possible. But when the macro view underwent a change last year, what we did when moving from defensives to cyclicals, what we did was that stay with companies that have higher operating leverage, avoid companies that have higher financial leverage. Wherever the balance sheets are so broken that the repairing of that is going to be really challenging, avoid them. Also, same thing within the financial sector. Wherever you see more stress in the balance sheet, avoid those banks, buy those financials where probably those stress is not there. And I think that operating leverage has played off very, very well. So whether in the auto space, whether in the industrial space, whether in the financial space, I think companies where the balance sheets are in a better shape, I think that has done well. I don't see that changing dramatically. We are not visualizing a couple of 100 basis point correction in the interest rates from these levels that several balance sheets can undergo a change in a very, very big way. So I think one should still avoid those balance sheets which are quite broken. Of course, as he said rightly, there are various ways of making money. There is no holy grail of investing. Of course, from a price point, lots of stocks will make money, but I think you need to be a little more cautious on that front.
Nilesh, so far we've discussed domestic challenges. Let me throw in one more ingredient in the melting pot, which is the global setup. And unfortunately, the world is still fighting deflation. Most of the large central banks are committed to print money. So ECB is committed to print money, Japan is printing money, and then what will add confusion, of course, is what US Fed will do, 2 quarters down the lane. So how do we deal with this dynamic global environment which is changing?
So, unfortunately, investors don't remember what their grandmother told them. So when we were kids, we had studied the story of Vaghaya, Vaghaya. The tiger has come, tiger has come. But unfortunately, when we grow up, we forget the wisdom given by our grandmother. So if you see the quantitative easing, our market shivered and corrected and crashed when people uttered quantitative easing will be withdrawn. When it actually happened, our market went up. So could the same experience be repeated with Fed exit? Our markets start shivering when we hear that Fed will raise interest rates. IMF chief came to India and said that if US raises interest rates, it will be tough for India. No one in the audience asked her the question that, do you think, ma'am, Portugal and Spain and Germany and Italy are better credit than US because their borrowing rate is lower than US? And we are paying 7.5%, 7.75, and you think we will be more susceptible? Shouldn't that the Italy and Spain and Portugal and Greece and those be more susceptible? So my guess is that as long as my macro is good, my micro is good, I don't really have to worry too much about what happens in US Fed rate. If US is raising rates, I mean, how much they will raise. There was a time, I think in 2005, when 10-year US yield was about 5.5%, or 4.5%, sorry, and 10-year Indian yield was somewhere around 6 or 7%. The gap was 1.5%. Today the gap is 5.5%, and we are still worried about, oh my God, that 5.5% gap is too small. So somewhere, I think eventually market will experience from what happened in quantitative easing. If US is raising rates, there will be Europe and Japan who can give us money. We launched a debt fund in Japan in September, and today it has become $650 million fund. The kind of return which we have delivered to Japanese investors, partly because our high coupon and partly because yen depreciation, is something which they will achieve in Japanese bonds probably over the next 20 years. So in India, you have the capability to get in 1 year what you will get 20 years in other markets. We have to go and market that. So as long as our micro and macro are stable, there will be temporary corrections because people don't remember what their grandma taught them, but eventually will come back.
So if you want to make money, just go to your grandma and ask her something.
If not your grandma, my grandma.
Akash, I want to encourage you to talk about global liquidity. You got your ears close to the ground. And well, India is the market of choice, but what about over-ownership patterns? 24% of good quality stocks are owned by foreign institutional investors. According to most GEM allocations and some of the articles you mentioned, that India is a crowded trade. We should not expect too much of flows. And I cannot imagine a scenario when we say, FI nahi aane wala hai. That's a nightmarish scenario.
No, I'm not. I mean, I think it's very clear that India is a consensus overweight. I mean, any survey you look at, done by any investment bank, it's very clear that the flow data indicate that. So I think the simple point I've been saying, and I think is now bearing out to a certain extent, is that the next leg of this market leadership will be driven by the domestic investor, not by the foreigners. The appetite for foreign investors to keep pumping in, whatever, $15–20 billion a year and being the buyer on the margin, being the sole driver of the market, I think those days, at least over the next 2 to 3 years, are not going to be likely, because the reality is that India is obviously very fashionable and hot today, partly for the points Nilesh makes that India, you're getting good returns, both debt and equity. The rest of the emerging market world is in really bad shape. You look at Brazil, you look at China's questionable, look at Brazil, look at Turkey, look at South Africa, look at Russia, there's lots well documented. So there is obviously a situation where a little bit like, the Indian election, the Tina factor, there is no alternative, right? But that is not going to last forever, obviously, right? It's not that the whole world will forever sucking wind and India only will keep doing well. So this is going to, at some stage, people will find, that some of the market things are turning, whether it be Brazil or anything. So at that stage, obviously, so there are two parts of it. One is that, that within the emerging market universe, I think the allocation to India right now is very biased, very highly, probably the highest I've seen it for a very long period of time. So I don't think that's going to increase in terms of India's market share within EM is not going to increase. Then you go back to see that will EM get a lot of new flows. There is a case, I think, over the next 3 to 4 years that EM will do better, because EM has done actually very badly the last 5 years. Look at EM, since the financial crisis, EM has massively underperformed the US and most global markets. So EM maybe will come back. But I still maintain, and I do believe that if this market, if India is going to work, and it's going to deliver the 15–20% return we all expect compounded over the next, hopefully 2 to 3 years, the domestic investor is going to drive this. I don't think you're going to get 15% compounding in the absence of domestic investors. If our expectation is that no, the foreigner will keep buying 20 billion and domestic investor doesn't matter, I think that's fallacy. That the foreign investor is up to his neck in India. There is no alternative. It's not going to last forever, and at some stage money will, at best, not keep increasing in India. India's market share will come down, flows to EM may come. So you may not see huge outflows, but you're not going to see the incremental 15–20 billion coming every single year. And remember, we are going to be a market of high supply. I mean, the government has talked 65,000 crores this year, whatever, something like that. That number is going to accelerate every year. There's no choice, right? And corporate India hasn't raised a dime in the last 4 or 5 years of any significance.
I have reported 5 IPOs in this week.
So that's going to start. So that, so this is a matter of time. So we are a capital short economy. It makes no sense that we don't issue any equity. I mean, we are going to be a high issuance of equity economy longer term, because we need capital, right? So, so I don't see how, in the absence of domestic investors, this market can sustain 15–20% compounded. So, so my simple answer is you need the domestic to come back. Do not rely on the foreigner. We've got till here because of FIIs. They may not withdraw dramatically, but they're not going to be the buyer on the margin, and they're not going to save this market if we have another leg down. My only point is that.
Navneet Munot is a very jolly man, but the minute you say domestic investors, look at the smile on this man's face. He knows his numbers. The SIPs are getting registered every day. 10 lakh SIPs in last quarter. EPFO is allowed to invest in Indian markets. Navneet Munot looks like in the right business at the right time. Tell me, is the domestic investor coming back? And if yes, how much money are we talking?
So against the $15 billion or so of the foreign flows in last 10 months or so, we have seen $10 billion
$10 billion
by the domestic, the domestic investors into mutual funds, and I think this is not, a flash in the pan, but I think it's a sustainable trend. We have seen over the last couple of years the savings getting diverted to more physical assets across the country you travel. I think there is tremendous stress in the real estate sector. I think people have made up their mind that I need to switch. It's just that you need a little bit of activity in the real estate, but even otherwise, I think the savings pool that we have, and also a couple of measures that the government has taken in the last couple of months. I think Jan Dhan Yojana may not lead to flow into the equity market, but the overall more financialization of the economy will lead to more savings coming into the financial assets. Also, I think, so I strongly believe that our vulnerability to the global events is likely to be less in the next couple of years than what we have seen in the last 5 years. We've been extremely tightly coupled with the global markets. We dance to the tune of global liquidity, global rates, global risk appetite, and you draw a chart of last 12–13 years of Nifty with maybe even a German DAX, and you see a very, very close correlation. Next couple of years, we will still remain hugely dependent on the global money, but I think to a large extent, I think that's going to go down, because I think the domestic savings coming into the market is likely to increase substantially. Also, I think the pension fund that you talked about, I think we have huge amount of savings. A country that saves more than 30%, which also I believe is likely to increase with the positive real rates of interest and the measures by the RBI and the government in the next couple of years. And a good part of that is likely to come into the equity market. So I think we will provide that, stability to the market in case we see any vulnerability from the global side.
Last time when domestic investors were back, fund managers, they became stars. So are people taking selfies with you again?
Not necessarily, but I think this is a structural trend for next several years. I think the equity ownership in India is abysmally low. Okay. I think we had much higher equity ownership 25 years back when we didn't have ET now, when we didn't have the live news, we didn't have so many business papers, business channels, dematerialization, this exchange trading at 1,000 places online. And so many things have happened, and we have lower equity ownership, and we are a younger economy with higher savings. I think it's going to get changed very, very dramatically. So $10 billion in a $2 trillion economy, I think just too small an amount. I think it's going to change.
Which is so appalling. Foreigners like India, we've got only not even 1 crore active demat accounts. One of our biggest company, HDFC, is owned by foreigners. So I always go on various forums and appeal to everyone. Well, foreigners are trusting Indian stocks. We should also trust Indian companies. So that's the standard appeal which I have. But I'm going to move away from that appeal and talk about the commodity effect, because 2016 will see a substantial movement. We'll see a substantial move, Prabhat, because of the commodity effect. Wealth will get transferred. Wealth will get transferred from a commodity producer to a commodity consumer, and that will be a global phenomenon. How will that change the dynamics?
So I think there are two parts to it. One is at a country level, which obviously India is a commodity importer, and we have already seen that impact. In terms of India's macros, why rupee is so stable is also partly because of the fact that we are now in a current account surplus zone, at least for 1 or 2 months, and it will probably remain like that if the oil prices remain here and the economy gradually improves. So clearly there is a wealth of transfer from one country to the other. The second obviously is within the system. So for example, you can take the case of oil. Oil prices have fallen $50, which is about $50 billion savings in the overall Indian scenario, out of which about $12 billion got taken up by the government in terms of raising of tax, about 72,000 crores. The rest is between the corporates and individuals. Now, depending on the pricing power of corporates, this will be either passed on to the consumer or will be kept back by the corporates. I mean, obviously, petrol prices are largely passed on to the consumer, but diesel, fuel oil, naphtha, which is consumed by corporates largely, some part will be passed on to the consumer and some part will be kept by the corporates. The fact that you're not seeing a multiple expansion because of commodity price falls aggregate basis will argue that there is more benefit to the consumer that is flowing in at this point in time than it is accruing to corporates. Well, this analysis is not fully foolproof, but at this point in time, it looks like because of the slowdown in the economy, the pricing power is comparatively less, which is visible in corporate top lines. As this sort of changes and as growth really picks up and the pricing power of corporate increases, I think the benefits from energy prices, low energy prices will also start to flow through. Obviously, companies like autos have very direct correlations, so they benefit very clearly. But if you start thinking about companies which benefit from commodity price impacts, there'll be 2 or 3 sectors will come up with. Autos, you'll say probably FMCG, which is benefiting from these kind of price declines. But the aggregate profit of these sectors is much lower than what commodity producers, like this Tata Steel has much larger profit than the entire auto sector in terms of EBITDA, right? So it's like 13,000 crores versus if you start adding them. So I think at the aggregate level, there's a huge benefit, but the transfer of that benefit depends on the economic conditions prevailing and the demand conditions prevailing. I think at this point in time, consumers probably have a better hand. And then the last thing I would say is within the economy, there's a transfer happening from rural India to urban India because the agricultural prices are weak. And the trend which was very much a driver of many stocks, for example, which were dependent on rural India, were benefiting, so they're benefiting from larger transfer of income from urban India to rural India. That trend has stopped, maybe has gone down somewhat, which is why you're again starting to see some dichotomy between stocks which are exposed to rural India versus urban India. Hopefully, what we'll see is an environment which remains conducive from India's perspective in terms of global commodity prices. One of the positive factors that plays into that is dollar strength itself, because as dollar appreciates, commodity prices tend to turn weaker because all the other economies which are experiencing currency depreciation are paying much more in dollar terms if the commodity prices don't fall. That's why commodity prices tend to behave with dollars. And going by all indications, dollar does looks like the dollar will remain strong. So from India's perspective, that's a very fortunate situation to be in, because at the time when you need capital to grow, if commodity prices remain weak, then you can actually, if you get a 3-year grace period and you can revive your investment cycle and get going, it's a fantastic thing from
But Siddhartha, my only issue with this argument is that it works on paper, that commodity prices or decline in commodity prices is great news. Reserve Bank of India will cut rates, but the challenge is transmission. 2 rate cuts, nothing has come down to the consumer. None of the banks have cut forward and they've cut rates. I don't think auto loans have really come down. So transmission, I guess, is the biggest challenge.
Yeah, that remains a challenge in the near term always. Typically, the pattern is the first rate cut doesn't yield much, second doesn't yield much, maybe after 3 or 4, and maybe with a bit of support on some of the other parameters like liquidity, you typically see a much stronger transmission. But the bigger policy message here at this moment is what really you do with interest rate tinkering. You try to manage demand, which has not really been the weak point of Indian economy more often than not. More often than not, over the last several decades, in case of India, the point had been how well you augment supply over a period of time. The good thing about policy making today is the last few months, or last 1 year at least, I would say, policy making is trying to bring the focus back on augmenting supply. Compare today's policies in terms of coal block allocation, or maybe more FDI in some of the more meaningful sectors, or over a period of time reducing interest rates, all are talking about boosting supply over a period of time. We often have some kind of a debate always, some kind of trade-off between growth and inflation. It's very true in case of most Western nations where they are close to their full employment level, or supply side cannot really go up a lot. In case of India, that is also possibly not true. If we try to really check a lot of things just by interest rates or mechanisms like that which control demand, Possibly you reduce demand a bit, but you end up reducing supply a lot more. So rather than trying to do that and try to manage the economy, a much better approach is to really boost supply, which the current set of policy making is trying to do. And in that kind of a situation, not only you possibly achieve a somewhat higher equilibrium in terms of growth, you live with a relatively smaller excess demand gap over a period of time and generally achieve both decent growth and relatively manageable inflation. See the experience of say 2000, the decade of early part of the decade of last decade, right? Where you actually had that combination. Obviously, global factors were also supportive, but I think we are gradually heading towards that, and over a period of time, I'd be very hopeful. Just one more point, and we briefly touched upon that, a lot of initiatives earlier we had been trying to do at a central level. I think another good focus, another good change in focus has been to drive states more. Two ways it can happen. The funding, which is coming to states without many conditions, so they can actually decide which projects to invest in. And the other factor can be, we emphasize, the new government emphasize a lot on ease of doing business. I think it's time to move and push this competition to a state level. Rather than thinking about India's ease of doing business, think in terms of ease of doing business in Tamil Nadu and Rajasthan and Gujarat, and let them compete. And possibly an investor can think like whether I'm investing in Rajasthan or Madhya Pradesh, rather than thinking of I'm investing in India, where ease of doing business is, the rank is 142.
That's a wonderful point, the ease of doing business, and that is what I think the current administration seems to be focusing on. Nilesh, now the session gone by, I think, was an extremely productive session, both in terms of decisions which were taken on the floor of the parliament and outside the parliament. So which to your mind is the most powerful bill which has been passed, and how will that bill change the dynamics in the short term?
So the most powerful bill which is not passed yet is the land acquisition bill.
We don't know what happens there, so let's talk about what is in the bag.
Yeah, but you can't build factories on Excel sheet. As a fund manager, we believe that way, but unfortunately that's not the reality. So you need land to build factories, and today, you know, acquisition of land is an issue. You take more time than peer group, you pay more price than peer group. If you look at labor productivity, it's one of the lowest in the world. If you look at interest rates, it's one of the highest in the world. If you look at clearances and approvals, it's probably longer than rest of the world. If you look at power cost, it's one of the highest in per capita GDP basis. So I'm making my entrepreneur run a hurdle race when everyone else is cruising on a highway. And despite that, our entrepreneurs are creating commerce, creating companies, and creating industry. So as Siddhartha mentioned, the ease of doing business has to come through. And will it come through new legislation? Probably yes, but will it come through the mindset change? I think that's more critical. About a few years back, we had met a multinational company who wanted to set up an orange juice plant in Nagpur, and Nagpur has one of the best oranges in the world. But the time taken to transport that juice in a refrigerated container from Nagpur to JNPT was much more than what they could afford. In between, the refrigerated trucks were open to check about the quality and what they were being transported, and in the process, the juice was getting kind of stale. So net-net, you couldn't put up the factory to convert that oranges into juice and create value addition for everyone. Now, that mindset has to change. The excise inspector, the pollution commissioner, the octroi agent, the shipping agent, the port agent, they all have to think that, look, it's my job to push this container ahead so that oranges can be converted into juices. Unless until we change that mindset, I mean, clearly our markets will have their ups and downs.
So what happened to that orange juice container finally?
We are still eating oranges, not the juice.
Prabhat, you know, bad or awful has become bad. It has not become great. The rate of change is productive, but rate of change is not fantastic. When you speak to companies, you interact with, what are the feelers you're getting? What has the new administration done? What can they do? And what can be achieved?
If you speak to companies, I don't think you will hear very positive.
So why are you bullish then? Growth is not there,
Well, so,
companies are not saying good things.
Well, if you'd gone in 2002 and done the same thing, you would have heard the same answers, exactly the same. You would miss the biggest opportunity of Indian markets.
Okay.
The point simply is that investing is not about what you hear today. Is you have to make judgments, as Akash earlier said, that you have to believe in what is going to happen rather than what is happening today. So you have gone through a phase of last. Well, as I said, the investment cycle is rather destroyed completely. You are still a shortage economy, so you can invest a lot actually and create productive assets. The issue essentially is that whether the right conditions are being put in place for a growth recovery. So growth recovery, so now we have money because we have current account surplus, we have all the conditions to cut interest rates eventually, and that will happen. And at the same time, so we have capital and we have opportunity, and the government is doing all the right things to create those opportunities. For example, mining. If that happens, if the mining takes off in coal, eventually you will have power investments. So I can definitely see that there will be a pickup from the levels you are at, and there will be a steady pickup. It will probably be, if you get the right conditions in place, it will continue to sort of go up like it went up in 2002. It was not one day that the market earnings just started going up suddenly. It took 7-8 years to reach that peak. But the peak journey to that peak was very profitable for investors. So I think that is what you're looking at. That's what you're playing for. Otherwise, obviously, there's no story here.
Okay, I've got some questions in my hand, but I would encourage you to participate more. It's a rarity to really have an interaction with such a panel, so I would encourage many more questions. I'll just do one quick round of Q&A, and then I'll open the floor to questions, and I'll take some chit cards. Prabhat, what's your big idea for FY16? What's your big sector? Where are you laying your bets in terms of the theme?
It was last year, it was financial. I think it sort of remains financials for us, primarily because I think a macro recovery will first be manifested in this sector. I don't personally believe that loan growth will pick up very sharply in the next sort of 1 year, but market will make a bet about that as the market sort of sees the headline growth recovering, investment cycle recovering. So it will still be financials. Financials, India is a much underpenetrated country in terms of leverage and overall. There are pockets obviously of over leverage, but I think as the investment cycle starts to grow, the visibility on the long-term growth of this sector will be very large, and I think you can get compounded sort of growth for a very long time in the sector. So it still remains to be the financial sector is still something that, like its size, it has large companies, it can and I think it has corrected actually. So that's another positive. Though, and the correction is marginal compared to where it has come from, but it's still a correction compared to a lot of other stocks which have just gone one way up, in the name of being safe havens. So when the recovery happens, people rotate away from the sectors most likely.
Akash, financials has been your big bet as well, but how does one play into financials? You've never liked PSU banks in the past, and congratulations, that call has worked like a charm. So what's your big idea, and how are you betting in financials this year?
We would continue to avoid PSU banks. Nothing against PSU banks, but I just think they're in a structurally difficult place with the government's inability to give them capital and the constraints they have imposed on them by the government in various forms, from compensation to, everyone is well aware of all those things. So I think you can, there are we have a couple of NBFCs. I would not like to get into names here because of regulatory reasons, but I think there are a couple of NBFCs which are, which are well capitalized, which can grow strongly. You can play that. There are a couple of older private sector banks which are again have got size and scale, which are trading slightly above what the PSU bank valuation is, but clearly the management is better incentivized. There's less government interference, etc. So I think there are, as Prabhat said, the financial sector is a very broad sector. You don't necessarily need to play PSUs. The PSUs, I would make the one caveat that if you genuinely believe, and we're still thinking about this, but if you genuinely believe that the government will allow these banks to function in a more commercial manner, it's a great trade. I mean, it will probably give you the single biggest upside from here will be, State Bank or I would stick to the top 3 or 4 PSU. But the government itself said they're only going to finance 6 PSU banks, whatever. So, why go below that anyway? It makes no sense. So look at the top 4. I mean, the government itself is telling you that. So so I think the call there really, I think it's still too early for us to make that judgment that this will actually happen, because there's tremendous vested interest, pulls and pressures, etc. But there is some stage, I think, going to be a huge trade, massive upside in the PSUs at the top 4 at least, SBI, PNB, BOB, and and whatever. I think the government frankly has no choice, because they can fudge here, fudge there, delay something, postpone Basel III, allow tier 3 subordinate. I mean, do these various fudges, but this will not continue beyond a point, because if you want the economy to grow at 7-8%, 70% of your banking system can't be in a position that can't lend more than 7-8%, 10%, which is what it is today. So the government someday has got to face the music, and I mean how they do it, I'm not sure, but. So I think I would advise people, and people have obviously different views on this, but if you genuinely believe that you're seeing change, you should look at that trade. It's too early for us, because we're not yet convinced that the government has enough of its back to a wall to genuinely make the changes required, but it will happen. And I would urge everyone to look out for that, and that will be a really, huge trade sometime in the next 12-18 months.
Navneet, where are you shopping?
Same. So I believe in the reversal in the investment cycle. So I think the industrials, even from, I think there's a lot of potential in the exports as well in that sector. So I think the overall industrial manufacturing. So I think in the next couple of months, as I expect the government spending to go up substantially, followed by a private capex, but at a later stage. I think within that, so if you are into forging, abrasives, compressors, bearings, gears, everything. So I think the whole industrial space to me looks quite interesting. Even in the consumption, I think we have a very long way to go. Of course, I think there is a part of the consumer sector which is quite richly valued, maybe the staples, but I think in terms of discretionary spending, urban consumption, also the premiumization within some of the segments, I think that it's got a lot of lag. Within the financials, I think there are three very powerful forces in the finance globally. So you have disintermediation, which is a very powerful force where borrowers go directly to the market, and maybe even the lenders will go to asset managers and wealth managers. You have digitization, I think, which can change the landscape of financial services very dramatically, and a much more stricter regulation for the traditional players in terms of higher capital and higher compliance costs. But there would be new players who will probably bypass that regulation. So it's going to be a very interesting space, because India probably is going to be far more bigger in terms of financial services where we are today, but the winners and losers could be quite different than the people who are there today. On the PSU banks, though, I think last couple of years we have stayed with private sector banks and well capitalized, well run, high growing NBFCs. That trade has done very well. But I think I get an initial signs that I think governance reforms are happening. Looks like the government is quite serious about the governance reforms.
You're saying this because you represent SBI.
Maybe because of the, I know because I'm from SBI, maybe. I think more, whatever you read, whatever you hear from the government, I think they're quite serious about the governance reforms. I think they have the franchise. I think some of them, I think particularly, again, I'll repeat on those three forces. I think those who are making good investments in the digital finance, I think the future is that. I think those could be a big beneficiary. But again, I think you need to probably wait and watch and then you can take your pick. So these are kind of early days. But there are like a couple of other space. Agronomy is the other one. I think in agri-chemicals or chemicals, I think we have similar advantage as a nation that we had in pharmaceuticals. That space over the next several years could be quite big, both from the domestic demand as well as what we can do in the international arena as well. And there are several interesting companies.
I'll use my privilege to ask last question, and then I've got a big deck of questions we'll take. Nilesh, we've been talking about what to buy, but investing is not always about what to buy, it is also about what not to buy. So for FY16, where would you not invest apart from metals? Metals, we know the answer. The cycle is not on our side, and that's the easy one out. But give me something new, a new thought.
So any company which is very heavily leveraged, which has very, very high debt, probably it's worth avoiding. Any company whose earnings growth is likely to be far lower than its PE ratio, that's probably worth avoiding. Any company where the governance standards are very, very poor, and I'm using very, very poor, not just poor, they are worth avoiding. So if you can avoid debt, high debt, if you can avoid very poor governance, and if you can avoid expensive valuation, you should be home.
My grandmother never told me this, but this my professor also told me in B school. Avoid bad companies which have a high debt and which don't have a good quality of business. I learned this 20 years ago in my MBA school. I want to know what your grandmother is telling you now for FY16.
So my grandmother is telling me a few things. One, she's telling me that I should go and meet Mr. Warren Buffett. And I should, go and meet investors of Mr. Warren Buffett also. And tell them that, look, I am a small fund manager from India. And for last 18 years, my company has managed a fund which in US dollar terms have delivered 4 times more return than what Mr. Warren Buffett has delivered. So we are outperforming the God himself.
SEBI law says past performance is no guarantee of future. That's the first thing you read in a mutual fund document.
Yes, but my grandmother says that history always repeats itself.
Okay, I'll open it to floor, and it's a lovely coincidence. Nilesh, I have the first question for you. What should be the broader asset allocation for next 2 to 3 years between equities, fixed income, bonds, and primary markets?
If you have the risk appetite, 100% in equity.
100 means 100, like 100. 100% in equity.
100.
Okay.
And I would have put another 0 provided market was in 2013 valuation.
Okay.
But since it is not, you have missed that bus. If you have the risk appetite, you will have to take 15, 20, 30% downside. But clearly, we are at a multi-year bull run. Stars are favoring us. Your interest rates are coming down. Your commodity prices are down. The government seems to be moving in right direction. You could be arguing with the speed, but not with the direction. The earnings growth are expected to come back. Our market is not as expensive or as much premium to global markets as it used to be. So put all these things together, we are probably at a similar phase like 2004 or 2005, where you look back, 2003 delivered great return, but even in 2006 and 2007, great return was made. So take the risk, you won't
100%.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.